Getting some headlines as well from the Richmond Fed president, Tom Barkin. Steve Leisman is here with that. What people seem to be centering on, Steve, related to Mr. Barkin, is comments about the consumer and spending and worries because of everything that's going on right now. What stands out most to you?
Well, this idea that he said, the Richmond Fed president, Scott, that there's a lot of reasons to be worried about consumer spending. I'm guessing he's taking that from a lot of the surveys and the sentiment surveys that have been out there. Maybe even more worrisome, Scott, was his comments that inflation expectations may have loosened. The Fed has been relatively sanguine about not the short-term ones, the short-term inflation expectations. It's the long-term ones that have been difficult. He also says firms have been defensive, delaying and deferring investments. That's something we've heard a lot of, Scott. There were two reports this morning. Richmond Fed came out with a report as well, Philly Fed, non-manufacturing, and the Chicago National Activity Index. All these numbers are really negative right now. Again, these are survey numbers. And Scott, it's why I would point your attention to Thursday, the durable goods report, not something that you get up in the morning and I suspect you're very excited about, but I will be, because it will reflect some of these real numbers that are out there in the economy. And we'll get a chance to see whether or not Barkin is right that we did have a decline in business investment as a result of all this uncertainty. So far, it's mostly the sentiment data, and I'm assuming that's what Barkin's pointing at, but we'll have to see as to when over the next month or so, the next couple of weeks, we get some real data on the economy, if that starts to factor in to the economy, and whether or not, again, you have this other issue, which is this China trade deal, if that creates some positive momentum. But I think that on second thought, it wasn't as optimistic as it sounded.
But let me ask you about that, the so-called soft data. Because the data from the surveys hasn't necessarily shown up in the hard data, the actual reports of what's happening as it relates to consumer spending and everything else, do you think that means in any way that if you get a more positive development related to trade, that you could have a faster sort of snapback because you haven't printed anything terrible, so to speak, just yet? It's all sentiment, and you can change sentiment based on headlines.
Yeah, most of it, Scott. I'll tell you the sentiment that I'm most worried about. I think that's a good way to think about it. It can come back quickly. The one I'm most worried about, though, is the job sentiment. When people are worried about their jobs, that can tend to shift spending over a long period of time till they feel secure about their jobs. So we keep seeing data about jobs that people don't think, like, if they lose a job now, can they find one quickly? That data is deteriorating. Are they worried about losing their job? That data is deteriorating. That's the sort of stuff. Scott, I was trying to think, and I'll have to do a piece on this and do more research. How many jobs now, when you do the federal spending declines, when you do the trade issues, even when you think about the people who are going to lose their jobs because of the end of these university grants in the science sector, how many people throughout the economy go to bed at night worried about their job the next day? I would submit to you, I don't know that number. I would submit it's probably in the tens of millions, and a meaningful number of people are now worried about their job. And it doesn't matter if they don't lose it. Let's hope they don't. But that could affect their spending, I think, over a long period of time here.
Well, it's always hard to quantify, I suppose, like behavioral economics. You're going on people's feelings and their sentiment and how that would translate into hard data. It's an inexact science, to say the least.
It definitely is. And one of the stories I wrote that was among the most passed around at the time in 2001, Scott, was the issue about consumer sentiment having really seriously plunged in the wake of 9/11. And yet people, because of an incentive to buy automobiles and other things, people were spending pretty robustly in the wake of that consumer sentiment decline. It's very important that you look also at the balance sheet of consumers, which are pretty good. We've had a rise in savings with an increase in income, in part because people have not been spending. So they appear to have the wherewithal. And I think this supports your theory, Scott, that there could be a turnaround if there was some confidence in the economy and some feeling that things were going to get better. I will point out on the other side of that, our CNBC All-America survey did suggest that people's views about the future have deteriorated as well. And this went along with all the other sentiment data. People are concerned. They say they're not keeping pace with inflation. So I know you talked about some of that stuff yesterday about their attitude towards the stock market. Again, that could turn around relatively quickly, but you really want to have people feel secure about the future to do the kind of spending today. The big story with sentiment numbers, Scott, tends to be big ticket items, not the day-to-day stuff, but whether you stretch out for those big ticket items, and that's when you feel secure about your future.